You spot a perfect support line on your chart. You place your buy order, feeling confident. Then the market crashes straight through it, instantly triggering your stop loss. It is a painful cycle, but this happens because our brains are wired to want to predict the exact bottom of a market drop. We want to catch the absolute lowest price before it bounces. This urge leads to a fatal mechanical error, placing a blind limit order directly on the 61.8% Fibonacci retracement level, hoping it acts like a magic trampoline. Touching a Fibonacci line in a vacuum means absolutely nothing. If the sellers are accelerating into that zone with massive volume, stepping in front of them without lower timeframe confirmation is financial suicide. Today, we are going to build a sniper precision setup. We will map the exact zones where smart money waits and establish strict rules that force the market to grant explicit permission before you risk a single dollar. Blindly buying at lines turns you into exit liquidity for institutional algorithms. To survive, you must demand structural proof over blind faith. This is a 15-minute NASDAQ chart. To build our setup, we start on this higher time frame to identify the macro market impulse. Look specifically at the established high of day and low of day structure to see the overall move. Next, we draw our Fibonacci retracement tool. You must anchor the points precisely. Drag the tool from the absolute swing low wick to the absolute swing high wick. These extreme wicks represent the true liquidity sweeps, so we never measure from the candle bodies. This creates our target area. The mathematical space trapped exactly between the 0.5 or 50% and the 0.618 retracement levels is called the golden pocket. Here is your primary rule of engagement. If the current price is not physically inside this drawn box, you do absolutely nothing. You sit on your hands. This constraint-based approach eliminates emotional overtrading. It takes a vast, chaotic chart and condenses it into one tiny, highly controlled action zone. Once the price enters the golden pocket, the location is set. Now, you must immediately drop down to the 5-minute micro time frame to hunt for your entry trigger. This is the 5-minute chart for that same setup. We need visual evidence that the sellers are exhausted. We are looking for a closed rejection candle, exactly like this black pin bar with a long bottom wick rejecting the Fibonacci level. But there is a severe warning here. You must watch the countdown timer on that 5-minute candle. Any action is strictly forbidden until that clock strikes 0. If you enter early, you are gambling. A seemingly perfect bullish wick can violently collapse into a massive red engulfing body in the final 10 seconds of the candle's life. Location alone means nothing without temporal confirmation. The locked-in candle close is the only true signal that institutional algorithms have shifted direction. With the entry confirmed, we must immediately define our exits. To do this without emotional bias, we use the Fibonacci extension tool to plot mechanical take-profit targets. This tool requires a 3-point drawing process. You click the start of the previous impulse, then the top of the impulse, and finally the exact bottom of your confirmed pullback. This plots your primary target, or TP1, at the 1.0 level. This represents a baseline equal measured move, where the new upward swing exactly matches the distance of the previous impulse. Your secondary targets, TP2, are plotted at the 1.272 or 1.618 expansion levels. These are designed for capturing broader trend continuation once the initial target is secured. Establishing these rigid mathematical targets before you even enter the trade neutralizes your psychology. It removes the urge to hold a position out of pure greed. Now we apply an advanced tactical adjustment, front-running your take-profit orders. Institutional algorithms know exactly where these Fibonacci levels sit. To guarantee your execution, you must drag your take-profit target fractionally below the exact Fibo extension line. Your protection must be just as precise. The structural stop-loss must be placed definitively below the 0.618 retracement line, or just beneath the absolute low of your trigger candle. If the market breaks structure and drops beyond the 200% extension of your pullback, the trend invalidation rule kicks in. Your trade hypothesis is dead, and you must accept the loss immediately. Combining front-run targets with deeply placed structural stops guarantees mathematical asymmetry. It protects your core capital from minor market noise while ensuring your winners pay out. The mechanical blueprint is now complete. You have mapped the golden pocket, confirmed the 5-minute trigger, set your structural stop-loss, and locked in your front-run targets. Executing this blueprint introduces a new psychological pain. Waiting for a strict 5-minute trigger candle to close means the market will sometimes spike and leave without you. When that happens, intense fear of missing out sets in. Your ego will desperately demand that you abandon your rules and jump into a moving market just to feel involved. Firm tone. You have to contrast the temporary psychological frustration of a missed opportunity against the devastating financial reality of catching a falling knife and taking a full 1% loss on your account. Fibonacci provides the location. Price action provides the permission. A disciplined trader demands both before engaging.